Within the topic of budgeting, we are going to investigate the projected income statement. The projected income statement is used to plan, monitor, and control the profitability of a business. It reflects the estimated income and expenses over the budget period, whether that period is a month, a quarter, a year, 6 months, etc. The projected income statement is used to forecast and plan the amount of profit a business is expected to generate through its operation. Thus, when preparing a projected income statement, the key word to keep in mind is profit. The projected income statement provides management with a forecast of the expected performance of the business over the budget period. If the projected income statement forecasts results that are unfavorable, then management can adjust the business plan ahead of time and develop new strategies to improve the projected results. Preparation and presentation of the projected income statement. The projected income statement has the same format as the normal income statement, except that here the figures are based on future projections and not past results. Also, often several columns are required since the budget period may span several months or even years. The projected income statement is usually prepared based on the previous year's income statement and taking into account any planned or predicted business activities, trends, and economic conditions. If you're able to prepare a normal income statement, then drawing up a projected income statement simply requires you to understand the given information and perform the necessary calculations to determine the expected income and expected expenses for the budget period. So the projected profit is equal to the projected income minus the projected expenses. Analysis, interpretation, and comparison of projected income statements. As mentioned previously, the preparation of the projected income statement is an essential part of the budgeting process. However, the real value of projected income statements lie in the information that it provides and the way in which management uses this information to ensure that the business objectives are achieved. Through effective analysis and interpretation of this information, management can ensure that the business activities are well planned. By comparing this information to actual results, management can ensure that those activities are well controlled and carried out according to plan. We will discuss this section in two parts, namely analysis and interpretation during the planning stage and analysis, interpretation and comparison during the budget period. Analysis and interpretation during the planning stage. During the planning stage, management will analyze the information in the projected income statement, and based on the interpretation of this analysis, they will decide whether they have made the best possible plans for the business. If management decide that they are not satisfied with the forecast figures, they will then re-strategize and look for ways to increase the expected profit by adjusting their plans. Management will then redraft the projected income statement and analyze the new forecast results in order to assess the feasibility of their new strategies. Through this analysis and interpretation, management can ascertain whether the business is expected to be profitable over the budget period, the projected sales figures are satisfactory, the planned percentage markup is adequate, in other words, enough to make a profit as envisioned, and expenses need to be cut. The business can afford to hire additional staff, run an advertising campaign, etc. Once management are satisfied with the planning, they will finalize and approve the projected income statement. Analysis, interpretation and comparison during the budget period. During the budget period, management will use the information in the projected income statement to monitor and control the business operations by comparing the actual figures achieved with the budgeted amounts. Management will then carefully analyze the comparative figures. Based on the interpretation of this analysis, management can assess whether the business is performing to expectations, they need to take corrective action, they need to investigate further in order to identify underlying problems. They need to implement or improve control measures. The budgeted figures were unrealistic and need to be adjusted in the projected income statement. Analysis, interpretation and comparison during the budget period. We are still busy with that. When comparing actual figures with the budgeted amounts, management will often analyze the data by using a technique known as variance analysis. In this technique, the differences between the actual and the budgeted amounts are referred to as variances. When performing variance analysis, management will usually draw up a table known as a variance analysis report. The variance analysis report sets out the following for each item in the budget: the budgeted amount, the actual amount achieved, the variance amount, which is the difference between the actual amount and the budgeted amount, the variance percentage. Management will then analyze and interpret this data. We will illustrate an example of a variance analysis report in the next slide. So we have an extract from the variance analysis report of Stick Stores for July 2018. We have our various budgeted items, namely sales, cost of sales, rent, income, salary and wages, advertising, water and electricity, the budgeted figure for each, the actual figure for each item, the variance, the difference between actual and budgeted. For example, 76,500 minus 75 is 1,500. And then 51,000 minus 50,000 is 1,000. 9,000 minus 10,000 is negative 1,000. We can then also calculate the percentage So we take the variance and divide it by the budgeted figure and multiply by 100 over 1. So 1000 divided by 10,000 times 100 will give 10%. And since this is a negative, it will be a negative percentage. An extra column is often included for comments or explanations relating to each item. A plus sign indicates a positive variance, so the actual figure is bigger than the budgeted figure. This is not necessarily a positive result for the business. It will depend whether it was an income or expense. A minus sign indicates a negative variance. In other words, the actual figure is smaller than the budgeted figure. Similarly to above, this is not necessarily a negative result. It will obviously depend whether it was an income or a sales item. So if it's an income item, a positive is good. If it's an expense item, then a positive is bad. Usually. The management of stick stores may interpret the results shown in the various analysis report above as follows. Sales. You can see it's slightly more than expected, thus a favorable result. Actual bigger than budgeted, therefore positive variance, therefore a positive variance percentage. If we take the 1500 divided by 75,000 multiply by 100, we should get approximately 2%. Cost of sales, similar thing, slightly more than expected, but in proportion to sale, that's why the variance is basically the same, both are 2%. So the markup percentage has been maintained. If there was a big difference between the sales variance and the cost of sales variance, then obviously the markup percentage would not have been maintained. The rent income is much less than expected, 10%. So we will need to investigate that further to see what the reason is for that. Salaries and wages as expected, so it's well controlled. Advertising, it's significantly under the budget, 60% under what we budgeted. So in the one sense, you may say, okay, well, our expense is lower, so our profit would be higher, but on the other side, it might have also been that if we use more advertising, we would even have had more sales, which would even have increased our profit more. So it's very contextual how you analyze this. So this was significantly under budget. Although this is positive from a control point of view, advertising normally has a positive impact on sales, and thus the advertising budget should be fully utilized. This will need to be investigated further. Water and electricity, you can see it is 40% over budget. So we need to investigate this urgently to establish the cause. Control measures need major improvement. Check whether electricity tariffs have increased unexpectedly. If so, make the necessary adjustments to the budget. Analysis, interpretation and comparison during the budget period. We are still busy with that. By comparing actual figures with the budget amount in the projected income statement and analyzing and interpreting the results, management can establish whether the sales targets have been achieved, the planned markup has been maintained, the projected income from other sources has been realized, for example, rent income. Each of the expenses has been well controlled, for example, telephone. The budget for certain expenses has been adequately utilized, e.g. advertising. The overall actual performance or profitability of the business has matched expectations. When answering a question on this section, you will be expected to demonstrate your understanding of the projected income statement, your ability to analyze and interpret the information in the projected income statement, and your ability to compare actual figures with amounts in the projected income statement and then analyze and interpret the results of those comparisons.